Welcome back, everyone. Michael here with Offshore Citizen. We are once again in Bulgaria, which you can see in the background here. This is the city of Sofia, which if you ever happen to visit Sofia, there is a great dish you can get at a restaurant called Golden Nero on Vitosha Boulevard, which is this great, we'll put a picture of it. I had it today. It's like, I always like to bring people and give them this specific dish at this restaurant. In general, the restaurant is, nothing special. They had two dishes, though, that were great. The one is the roasted eggplant with buffalo mozzarella and tomato marinara sauce. Awesome. They used to also have, and maybe they will bring back if you happen to go there, the raspberry tiramisu, which was also amazing. Awesome. Anyway, that's to diverge. Today we're going to talk a little bit about stock investing. So I've had some other videos where I've talked a little bit about, my position and perspective, etc. I have five filters, I would say, for investing that I utilize. And so these are not what anybody else should be utilizing. People have different goals, different objectives, etc. But since some people ask, I figured I would share kind of my perspective on how I make these decisions, and you can, develop your own, etc. If you have your own, I would love to hear them. Put them in the comments below. I think this is what would be interesting to share. Number one would be, what is it that your investing objective is? And then number two is, what are the filters that you apply in order to try and achieve that? So this is all to do with stock investing. And so I think it's, obviously one of the more popular areas of a person's portfolio. Probably for most people over a long period of time should represent, on average, the larger portion of their portfolio. But again, different people, different objectives. So we're going to dive in and discuss it today. Before we do, if you haven't already, please hit the subscribe button, hit the all notification bell. Thank you for your support. If you are new here, welcome. I am Michael. Here we help you with custom, holistic, international solutions for business and personal. We can help you with figuring out the right strategy for you, whether it's where to go or how to optimize your tax or what citizenships to get, what companies to form, banking, etc., as well as I myself and our team can help you with the implementation of those strategies. So if that is interesting to you, please reach out to us. You can book a call with me, calendly.com/Michael-Rosmer, the link in the description below, or send a message through offshorecitizen.net. Okay. So just some context around objectives, because I always think it's important with anything to begin with the end in mind, right? What is it you're trying to achieve? That lens through which you're looking should influence everything else. For example, if what you're trying to do is prepare for retirement in 10 years and you've already got enough and you're just kind of looking for something slow and steady, that is a different objective than somebody who is just getting started and trying to get rich, which is different than the person who is, risk averse and has done well in their regular business, and they're basically just looking for capital preservation, et cetera, et cetera, et cetera, right? So usually I think people are optimizing for considering time horizon. That's one thing. What are your time horizons you're looking at? Number two is, are you optimizing for volatility, right? Or for cash flow, or for, to be fair, those can go together, or for higher yield, right? These are just different types of objectives. Sometimes liquidity is important to you, sometimes liquidity is not important to you, and so kind of deciding for yourself is really important. Now for me, liquidity is not so important to me from an actual, I don't need the money perspective. So in that sense, I'm not really so worried. The only reason I particularly care about liquidity is for the optionality of it. I think there's a lot of benefit to having liquidity, which is one of the reasons why I'm much more interested, for the most part, in investing in stocks or crypto than I am doing angel investing. I'll do some angel investing, but the illiquidity of that asset is something that I dislike. So that's a factor, okay? Next, I'm taking a fairly long time horizon. I would say, in theory, I'm happy to hold for decades. I'm not too worried about it in the short run. However, then the thing where I think I deviate pretty radically from most people is that I am looking basically for 10x and 10-year gains. So this is Warren Buffett level returns. Okay, for those who don't know, during the first 3 decades of his career, Warren Buffett averaged 10x every 10 years, so 1,000x over 30 years. I don't expect to do 1,000x over 30 years, but 10x in the next 10 years is the objective that I've kind of set for myself. Now, in percentage terms compounded, that is 29% a year approximately. So that gives you a bunch of different parameters there. Again, this should not be everybody's goals. It's just purely personally for my goals. And that has to do with, kind of other things that I want to achieve in my life and trying to work that out. And it's entirely possible that I will be unsuccessful at that goal. Maybe I'll get lucky and do better, but this is the objective, okay? So with that in mind, the filter that I have immediately, anytime I would look at a stock is, of course, from this lens of saying, okay, great, I'm happy to have a long-term time horizon, that's no issue. I'm happy to give up liquidity if need be. I'm not worried about cash flow, but I am worried about the potential upside. And so just kind of so you have that context. There is one other thing, and this is going to be starting at the first filter. So we have 5 filters. This is it a healthy company? And specifically here, what I'm saying is, look, I take all kinds of risks in business and doing different ventures, etc. I put in my time and this sort of thing. I don't want to lose that money. I've already got that money, right? So I want 0 losses. Now, I can have drawdowns. I'm perfectly prepared to have the prices drop at times, etc. But over a long period of time, I do not want to lose the money. Okay, so that is the first filter. And how do I look at that? I look at it principally just based on the health of the company. And so to me, this is number 1, what does the balance sheet look like? So in particular, what are the cash reserves that the company has? Debt to some extent, although a little bit less. And then looking at both the cash flow and the profit and loss statement, paying attention to the profitability and the free cash flow. Now, it's not inherently important. You'll see some of the companies that I invest in do not have to be profitable. It's not a requirement for me necessarily, and certainly profits can vary. Just like it doesn't necessarily have to be free cash flow positive, but if it's not, then I want a significant cash cushion in place so that I can say, all right, well, I know they're not going to need the money anytime soon, which means I'm not going to have likely dilution of my shares, and they can go through and end up in a profitable position. So it's very much cash driven and being able to sustain losses for a long time, although ideally also profitable and ideally free cash flow positive. Okay, so that's the first filter that I am looking at. If you want to expand it a little bit, paying attention to what is the overall business environment and do I think there are likely critical risks that could result in it being taken out, those would also filter it out. So that's filter number 1. Filter number 2 is fundamentally about growth. And to understand the basic mindset here, I always take the view that if the business does well, the stock will follow. Might be a lag, right? That's fine. Again, I'm happy to hold for 5 to 20 years, so it's not a big deal to me. What is important, though, is that the business is going to do well. And I measure this largely through growth. Now, you do have ultimately earnings growth, but pre that you'll have revenue growth, and potentially pre that you may have like user growth, audience growth, some other different growth metrics. Now, you can just kind of think of it this way. If you want to do 10x in 10 years, you have to average 29% a year compounded every year for 10 years. And so how do you get to that if you have low growth, right? If you're growing at 5% a year, you're probably never going to hit it. Now, yes, you could get lucky and there could be some weird random pump in the stock. You can see things like AMC and GameStop, etc. I don't buy any of that stuff. I do no meme stocks. I have zero interest in these kind of speculative pumps, etc. I'm looking for solid quality companies that are growing rapidly and are going to continue to grow rapidly. Okay, that's kind of my basic criteria. So I'm looking for pretty high rates of growth here. Usually I'm looking for in excess of 30% a year growth. This being said, growth is not going to be steady. For example, you could go and you could look at Tesla. I'm not an investor in Tesla, but they had periods where revenues weren't really growing while they were putting into place more manufacturing, et cetera, and then they kind of shot up from there. So you can have various reasons why there may be ups and downs in the growth, but overall, I'm looking for rapid growth in this. And you can kind of think about this logically, right? You can say, okay, well, if I'm going to try to get to 10x in 10 years, how am I going to get there? I have basically a combination of two things based on fundamentals. One is that I buy just at a huge discount, right? Now, I don't typically believe I'm going to buy at a 90% discount. So the theory essentially here being that the intrinsic value, you will eventually have the stock return to the intrinsic value of the company, right? That will eventually happen. So whether it's overpriced or underpriced, it will eventually return there. Now, the intrinsic value can be changing over time. So that's where it's, is it solid or growing or whatever? But fundamentally, this is the metric. We care a lot about intrinsic value. I don't believe that you're going to buy a quality company at a 90% discount to intrinsic value. And so that's not going to get you there. You probably can get a discount, and we'll talk about that in a little bit, but probably not that much. So hence, what is my other alternative? My other alternative is growing. Now, there are companies that grow at over 30% a year for a decade or more. And sometimes they do it, usually the way that they do it is by very high rates of growth for shorter periods, and then it kind of tapers down, which would be what you'd expect. So for example, there was times when Apple was growing at like 100% a year on their earnings. Facebook, same sort of thing, growing 100% a year on earnings. And there's various other companies you can see that are growing like super fast. So for me, that's like a key metric, right? How fast is it growing? And I'm ideally looking for above 30%, because I figure that over a 10-year period, that number is probably going to drop off, okay? So that's filter number 2. Filter number 3 is the ceiling. And this is something that I think a lot of people don't really pay that much attention to. It's often very bizarre to me that people don't pay more attention to market cap. Market cap to me is like a really important thing because it gives me some idea of just how far this can go. So for example, Apple, great company. There's no way on earth Apple is going to grow 10x in 10 years. Why? Because it's a $2.5 trillion company. It's already the biggest company in the world. That would put it as a $25 trillion company. It's simply, there's just simply not the market available for that to happen, period. Now, this is, if you look at factor investing, which you'll find from the research, is that small cap is a factor which produces superior returns without taking on additional market risk, okay? So whole conversation around that. However, you will notice that it's not because something is small that it inherently ends up having better returns over time. What is important is how far is it from its ceiling, right? Certainly if you can grow and you have a large runway before, or a large, a long road you might call it, before you hit that peak, that's really good. That's what I want. So if I say, okay, well, let's use an example. Say we're talking about the real estate industry. Okay, if you're buying a business that has a $1 billion valuation and you're in real estate, and you can go and you can look at comparables and they're all 15 billion plus, and say, well, there's clearly a long runway in order to get there. Clearly I could get 10x, I could get 50x, I could get whatever. Obviously, depending on the specific segment. So I can get this by looking at what is the market share that the company has, okay? Number 2, what is the market cap itself in terms of just overall size? Number 3, what is the situation with respect to the actual comparables, right? In other words, other companies that are in kind of the same sector, is there some reference point there that I can have that shows me how far we can go? So, for example, I wouldn't buy Activision Blizzard, I forget what they're at, $70 billion market cap or something like that. It's just too big, right? But if there's a gaming company that is $5 billion, then I say, okay, well, I can compare them to Activision Blizzard. Clearly there is enough market there that if the company delivers and it grows and it has all that stuff, then there is the upside that it could potentially get at least to 70 billion, because we know there's other companies at 70 billion, right? That's kind of the basic idea here. So I'm paying a lot of attention to that, which basically means I'm mostly, not exclusively, but mostly buying small cap, once in a while mid cap. I think the largest company that I own is around a 40 billion market cap. So that gives you some idea. Usually it's kind of like $1 billion to 40 billion, but most of them are, in the low few billions range. Maybe once in a while a little bit under, but usually in that range. This brings us to filter number 4. Filter number 4 is essentially, is this an excellent company with some sort of like clear, durable differentiation? So in other words, what I'm interested in understanding is, okay, it's one thing to say that it's growing fast now. It's one thing to say that there's a lot of space there, but how is it going to keep growing? And what we know is that, generally speaking, competitive differentiation, especially durable differentiation, which you might call durable competitive advantage. That was kind of the insight garnered by Phil Fisher. If you read his book, Common Stocks with Uncommon Profits, that's kind of the main premise, right? And Warren Buffett will reference it a lot. So we're looking for a durable competitive advantage. Do they have a durable competitive advantage? And so here I'm looking at a few things in particular. One of the, obviously, like researching the company itself and understanding how the company works. But the second thing that I'm caring a lot about is margins. So what you'll find is if a business is in a situation where they have a high degree of competition, then that's going to erode their margins. And so when they have very high margins, right, I'm talking about gross margins here, by the way, generally, then that's a good sign. You'll often find if a company's in the early stage and they're ramping up, et cetera, it'll have like losses. So there's negative operating margins and stuff, and negative net margins. So that sort of thing is tougher to say. But I can at least look at gross margins. And so it's concerning to me if their gross margins are not pretty substantial. I want to understand why that is, and I want to make sure that it's large compared to their competitors. And you'll see this, for example, Amazon has higher gross margins than a lot of similar companies because of the way their business model is. So even though they don't make a lot of money in pure terms, meaning they're spending a lot, they're growing, they're reinvesting, et cetera. They, for a lot of years, were losing money. In spite of that, their margins on a gross basis were fairly high compared relative to other businesses in kind of their sector. So that's a very important key. The second thing that I care a lot about in this regard is market share growth. So I want a space, when I was looking at growth, I'm looking partially at, is the sector itself growing, because a rising tide raises all ships, right? We want a lot of tailwinds if we're trying to go for what is a pretty abnormal outcome, right? It's not very common that a company is going to do 10x growth in 10 years. They're the outliers in that particular case. So you're trying to pick some substantial winners that, frankly, just it's going to be hard. And so if that's the situation, what I want to say is all right, well, how does this work? I need to be in a situation where I have things going for me. And one of those things is if I'm in a rapidly growing industry. You think about what drove Jeff Bezos into Amazon. It was how fast the internet was growing, right? Very, very important. So I'm caring about that. But within that, what I want to care a lot about is the market share. This is, in my view, like an early tip-off to which product or service is being favored by consumers and which is going to go somewhere. I remember back in the day, this was what tipped me off to BlackBerry kind of going down. BlackBerry was growing in absolute terms a lot, but their market share was being lost to Android and iOS. Another thing that they had there was the recommendation. So it was like 90-some% of people who had an iPhone would recommend an iPhone to their friend, 90% with Android would recommend Android to their friend, and 80% with BlackBerry would recommend their friends buy an iPhone, this sort of thing. So these are metrics for trying to figure out, all right, am I in a situation where this company is likely to continue to do very well and have outperformance? I want something that has outperformance. Ideally, I want essentially a monopoly in what I'm dealing with. So there's just a lack of ability of competitors to recreate what they're doing, or at least to recreate it easily. Okay, so something quite unique in what they're offering. Warren Buffett would say, either buy low, sell low business models are good, or else unique product and service business models. This brings me to the last one, which is valuation. So I mentioned, all right, we want to have that growth of 30+% per year, right? But we also know that that growth rate is going to come down. It's hard to figure out where you're going to land in that regard. And so it's better if you can juice it the other way, not to mention it will reduce your risk. So I'm interested in buying at a substantial discount where possible to intrinsic value. So I want to look and I want to say, okay, is it cheap? Now, this is a difficult thing to figure out. I think the first part to pay attention to is, generally speaking, I want to buy when it is down on a historic basis. So if the prices have been up and the prices are down quite a bit, that's good. It indicates to me that, well, at least the market could price it there before. So, it's not totally unrealistic that it could potentially go back to that level. But then again, I'm also looking at metrics like price to earnings, price to sales, price to free cash flow, price to book. Price to, a lot of those I don't necessarily give an absolute amount of credence to, and certainly having a low ratio in a bunch of those is not necessarily that important. For example, you can get a lot of companies that the reason they have a low price to earnings ratio is they simply don't have the growth, right? And so you're often going to have a trade-off in that regard. And it's okay to have a high price to earnings ratio if you're growing very rapidly and reinvesting really aggressively. But I want to try and figure out, what do I think this company is worth? And then I want to discount it by some sort of margin of safety. I want to say, okay, I could be wrong. And because I'm wrong, I'm going to discount that by X, which makes it a little more likely that I'm not wrong. And then I'm going to buy accordingly. And so kind of all those 5 things for me have to line up in order to result in picking this stock. And the idea essentially being, all right, let's say that I am aiming for 30% a year growth and it falls short and it hits 20%. Well, 20% happens to be a 5x in 10 years return, which is still, by most people's standards, really good, right? So 20% a year over 10 years, approximately 5x in 10 years. But it's not my 10x goal, right? Well, if I also was able to buy at a 50% discount, then I just amped it up. So now that got me from the 5x to the 10x, even though the growth fell short. So you're trying to stack these different things on top of each other to get there. So not saying that, you should do this, not saying that this is, necessarily the way to do it or be successful. Lots of people, everybody's got their theories out there. But I think that if you're going to do it, so for me, it's not like I can go find a financial advisor who's going to deliver those types of returns for me. It's just not going to happen. Second of all, I enjoy the process. So for me, it's fun figuring out about the businesses and examining them and doing research, et cetera. So I enjoy self-managing my portfolio. I also find it more satisfying if I do well, and then I only have me to beat up if I do poorly. So that's something reassuring. And then on top of that, I think you're taking ownership of your own objectives, and so that's for me. You guys, I would love to hear what your positions are, what you do to make selection decisions and how you analyze, etc. I will note that I don't look exclusively at say like what's in financials, etc. I think that's a bad idea. I think that fundamentally what you're going to find is if it's on the financials, balance sheet, P&L, cash flow statement, etc., then everybody else can see it. So you have no real edge in that situation. You have to have some sort of an edge over the market. And maybe that's that your time horizon is better. Maybe that's that you're going to be in a situation where you're more disciplined in your psychology and things like this. You're able to take advantage of good timing. Or maybe you have some sort of unique insight into the market. And sometimes you will, sometimes you won't. And sometimes you're going to fool yourself where you think that you have an insight and you don't have it. And so for that reason, I tend to take, approximately, 20 or less positions, but I spread out between, it depends on at what point in time. And then I'm going to revise those positions and say, okay, is my thesis still true? Is the company still doing well? Do I believe that I made a mistake here? And I'm going to adjust accordingly. So I hope that helps. Let me know if you have any questions. If you want help with any of the international stuff that we handle here, please reach out to me, and I will look forward to seeing you on the next video.